Welcome to Cal CPA's Tax Bill Series. I'm Rebecca Stidham, CPA and tax partner with Withum Smith+Brown. Today, we're diving into the latest changes to the SALT cap and the pass-through entity tax and what they mean for you. For taxable years beginning after December 31st, 2024, the bill increases the deduction for state and local income and property taxes to $40,000. This is an increase from the previous limitation of $10,000. The $40,000 deduction is decreased if a taxpayer's modified AGI exceeds $500,000 or $250,000 for married filing single, and it will be limited to $10,000, $5,000 for married filing single if AGI exceeds $600,000. Therefore, under the new tax bill, there is a phase out of the $40,000 deduction between AGI of $500,000 and $600,000, but the deduction cannot go below $10,000. Beginning in 2026, the deduction increases to $40,400 per year, or 50% of that if married filing separate, with income limitations of $505,000, half of that if married filing separate. Amounts will continue to be adjusted until the state and local tax cap reverts back to $10,000 in the 2029 tax year. So this is not a permanent change. With regard to the implications for the PTET workarounds and multi-state tax planning, the House and Senate bill originally included limitations for the PTE deductions for specified service trade or businesses. However, the final bill that passed, that language was stricken. Therefore, PTET deductions for both specified service trade or businesses, such as accounting and law firms, as well as trades or businesses that utilize the 199A deduction, are allowed to deduct the PTET for federal income tax purposes. Specifically for California, the governor signed SB 132 on June 27, 2025, extending California's PTET regime for an additional 5 years, given that there is still a federal SALT deduction limitation. During this extended period, entities that do not make the required June 15th prepayment will still be able to make the election, but the amount of the credit that can be claimed by the owners is reduced by 12.5%. Previously, if a taxpayer missed the June prepayment, they were ineligible to make the California PTET election. This provides an additional planning for companies that may not want to or cannot make a June 15th prepayment. They can still take advantage of the California PTET regime at a reduced 12.5% credit of any underpayment made on June 15th. It is important to ensure that the PTET deductions are not duplicated in ordinary income and on Schedule A. So be sure that if taking a PTET deduction, that you're not also taking a state and local income tax deduction on Schedule A. There's no double dipping of the PTET and the state tax deduction. So with the increase to $40,000, you still need to ensure that you're only taking a deduction once for your state and local taxes, whether that's ordinary income or as an itemized deduction in Schedule A. Entities that haven't previously made a PTET election should consider the burdens and benefits of doing so, given that the federal SALT limitation is still in play. Please stay tuned for more episodes in this series.